What happens is investing, what you need is the frameworks. So how to look at particular thing, how to look at interest rates, how to look at the earnings growth, how to look at the quality, how to look at business, how to look at management. So like this, there are hundreds of questions. So I might be having arsenal of 50 frameworks. Buffett might be 150 frameworks. And 150 frameworks is not 3 times of 50. They are like infinite times of 50. Because every framework adds massive power to your analytical capability. Somewhere in 98, 99, we talked about mathematics of Buffettology. So in Buffettology, Mr. Buffett, he tries to see the 3 buckets of value. In any company, there are 3 buckets of value. There is a breakup value, there is a franchise value, and there is a growth value. And you have to be very clear. So breakup value becomes very small the moment company starts becoming very profitable. So in franchise value, the quality starts coming in. That's why we call it Q. So the franchise value is very large in good companies and the breakup value is very small. If you look at Colgate or Lever, the book value will be maybe 10 rupees, 12 rupees, 15 rupees. Whereas the price of the stock will be 200, 300, 400 or maybe even 1000. So book value will be very, very small portion. They are being valued very high because their return on equity is running into 100%, 200%, literally infinite. They don't use any of the capital to make money. That's the highest order of business. When you don't use capital to make money. So that's a franchise value. Then these companies are very expensive because they are very profitable. But we still want to make money. So that you make money purely because of the growth value. So this fantastic franchise, if Colgate is making say 500 crores and return on equity is say even 100% year after year. But if it remains at 500 and you pay say 40p or 50p, you will not make money, even if it is Colgate. That 500 crores earnings must grow at 10-15%. Then you will make 15 plus maybe 5-6% yield. That will make you about 20% kind of a return. So you need franchise value. See, if you have only breakup value, if the assets are available because they are loss making or they are very bad, if the breakup value, if book value is 20 rupees and you are getting for 20 rupees or even 15 rupees, they are very expensive. They are very expensive unless there is a earnings power, because market loves earnings power. And if there is no earnings power, assets are lying, I don't think anybody cares about it. Only in the peak hours, in the bull run, when market becomes irrational, then these dead assets, they become expensive. But typically, the only breakup value companies where there is no earnings power, they will not be valuable. So you need breakup value, you need franchise value, and you need growth value. And that mathematics is one of the studies where we clearly wrote. And this book is one of the seminal book on Buffettology. Then at the turn of the century, sometime in 2001, Buffett wrote an article in Fortune magazine where he said, at all times, in all markets, in all parts of the world, the tiniest change in the interest rate changes the value of every financial asset. And this quote is more relevant today than ever. Today, there is no interest rates in 2/3 of the world or 3/4 of the world. The world which really matters, America, Europe, Japan, even China is heading towards that. So much of deflation is there. People are issuing 10-year paper at 0 or negative interest rates. A lot of high-end corporates like Nestle, they're able to issue bonds, fairly long-term bonds at 0 or probably negative interest rates. They're trading at those rates. So this is very unprecedented times. So what should the value of financial assets is? Actually, technically speaking, you can be 30p, 40p, 50p if the interest rate is permanently done. But the world knows that it is not going to be permanently 0. Maybe it is 1 year, 2 year, 3 year, 4 years. Someday, investor sentiment will rise and global consumers will assert themselves and inflation will come back. But this study we did in 2002, when the interest rate for the first time in India had crashed from 11-12% to about 5%. And that time, all the banks were available at fraction of the prices. That time we started buying all the PSU banks. In 2002, SBI was available for about 200 rupees. And the total market cap was about 10 or 12,000 crores for the SBI. And the bond gains, because of the change in the interest rate, was running into 15 to 20,000 crores. And the bond gain was 15-20,000 crores and the entire SBI on top of it, and you could buy the entire company for 10,000 crores. That was the kind of, possibility it was there. So when you learn these kind of things, you can see a lot of values. Then we went to, we were doing other studies. Then we did another study on terms of trade. One of the things was that you need to buy the companies or businesses in your portfolios which are in seller's market. They sell on their terms. In businesses you go, either you are on seller's market or in buyer's market, where the consumers, either the company has a say on you or you have a say on the company. You get discounts. You go to any other shopping mall. I mean, the guy is willing to give you anything for you buying 10-20,000. By the time you buy, he will give you this benefit, that benefit, because they are not in the seller's market, they are in buyer's market. When the terms of trade changes, what happens is there is no working capital. There are three types of payment mechanism. You buy something, you pay then and there. Typically in retail, that's what really happens. But in the realm of businesses, you have many times you get 60-70 days to pay for your purchase. Then there is an advance payment, prepayments also there. So what is the terms of trade in a business? At times it is because of the culture, but at times it is about the strength of the businesses. So we did this study. The businesses where profitability is high and terms of trade is favorable, you end up making tons of money. Look at Hero Honda. In 1996, when we bought the product, when we bought the company, at that point of time, there was acute shortage of motorcycles. There was a premium of 3,500 rupees for you to buy on spot. Otherwise, you have to wait for 15 days, a month, or whatever. So the terms of trade was seller's market. They could get away with anything. Today, if you want to buy a bike, you know what happens? They give you loan, they give you discount. If you ask for one, they'll give you tens of motorcycle. So the whole term has changed. You have to look at the terms of trade today. Between even within the two-wheeler segment, Eicher has a different terms of trade than Hero Honda. In Eicher, you can't get the terms today as you can get in Hero. So terms of trade for Eicher today is very different. You have a 3 months to 6 months waiting list. Whereas in Hero, you have a 3 months inventory lying in their godowns. So that's the basic difference. So you have to look at the businesses which have terms of trade in your favor at the time of purchase. Then I think one of the best studies, then the studies started becoming better. We started learning how to do it, and then we did, till about 2007, we're doing the side part of it, the specialist part of it used to be very small. From 2007 onwards, the thing started taking a very serious shape. So we did one study called India, the Next Trillion Dollar Opportunity. In 2007, what happened was that the Indian GDP was at about 45 lakh crores, and the rupee dollar parity came down from 45 to 42. So suddenly we got into $1 trillion club for that particular year. Then we said, let's study this particular phenomenon and what is the significance of this. Because we were about 12th or 13th economy to enter a $1 trillion club. And what is the experience of China? China became a $1 trillion in 1998. Nobody knew what China is. Today, everywhere it is China. And that is what exactly is the opportunity for India. What happens is that when you grow to $1,000 per capita, your discretionary spend is very thin. But when you go from 1,000 to 2,000, your discretionary spend go almost 10x. So what is a linear GDP growth is an exponential business opportunity. So you have to position your portfolio into the companies where this exponential growth is going to happen, because market is not pricing it. So that was one of the, I would think in top 2-3 wealth creation studies out of 19, it is one of the best and relevant even today. As relevant, probably more relevant today, because at that point of time market was at a high. 2007-8 market was running high. I was thinking market is able to see this next trillion dollar opportunity, but it was actually a Lehman credit bubble and it got burst. But the fact remains that we are looking at next trillion, third trillion will come by 2017 or 18 or maybe 19, in just 5 years. The last one came in 6 years. So we are at the cusp of a massive discretionary spend boom. And that's why all the stocks which are going to cater to the discretionary spend in India and has a monopolistic position, they are very, very expensive. They're almost double of what should be the normal P multiple. If it should be 30 P multiple, they're at 55, 60, 65. Because they're expecting this bull run to happen in discretionary spend. Then the next study we did was again in 2008. Buffett wrote, what are the 3 types of businesses? I think this is the best piece written by him in annual reports. In 2007 annual reports, page 6 and 7, if you go, he has written what kind of companies he likes and what are the traits he looks for in those companies. And he termed it, there are only 3 types of businesses in the world: great, good, gruesome. And these are like 3 savings bank account. A savings bank account where you put your money at a high yield, say 20% interest somebody is giving. So that's a very good return. If you are getting your business earning 20%, it's very good. So that's a good company. It's not a great company. Great company is a company where you put 100 rupees, he gives you 20%, first year, second year it gives 25%, third year gives 35%, then 40%, then 50%, 100%, 150%. You look at Nestle. Nestle in 2001-2, it used to earn about 25% return on equity. By the time it was 2011, it was 135%. You go and see how it has improved year after year. That's what makes Nestle a special company. So, rising ROE. So, great and good was very clearly understood. What is a gruesome? The real challenge for the investor in the market is to throw out gruesome businesses. Now, what is gruesome? A bad business. A bad business is a business which actually breaks the capital. If the cost of capital is 10%, it earns 5-6%, or actually it incurs loss. But even that is not a problem, because it could be just a historical thing. It could be misfortune of the business that it is not doing well. But the problem is the management is mandated to grow the business, which is very bad business. So what happens is you are earning 100 crores by deploying, say, 2,000 crores. Now you want to double the profit from 100 crores to 200 crores. What do you need? Another 2,000 crores. To earn 100 crores, you need 2,000 crores more. So it becomes a bottomless pit of capital. And everybody gets sucked in because these companies are available very cheap. And most of the retail guys, they get sucked into buying these stocks. And they stay on because they are not making losses. Return on equity is very low. Valuation is very cheap. What more you want? You're buying cheap. You can't go wrong. But it doesn't make money because the company itself is not making money. One other thing is, I don't know if anybody knows how much money you make in the market. From a stock, how much money you make finally? You make as much as the company makes. Please understand this. If company is not listed, you start with a crore rupees company and you make 1,000 crores over a period of time. At the end of it, you'll get 1,000 crores, period. So you cannot make more money than what the company makes. People think that they can make more money than what the company makes. And that's why they don't bother about what the company is doing, they bother about what's happening in the stock market. So fundamentally we have to understand, we have to buy great businesses who are going to make a lot of money, not only now, in next 10 years, 20 years, 30 years, 40 years. And that's what we do. And that's what has, this particular study, if you see, we gave an example of Nestle as the great company, HDFC Bank as a good bank, good company, and I hope there is nobody from Tata's, Tata Tele Maharashtra Limited as the bad company. When I wrote as a bad company, Tata Tele Maharashtra Limited, it was making losses of 60 crores per quarter. Do you know how much losses they are making now? After 7-8 years. They are making very faithfully, every quarter they make a loss of 165 crores per quarter. They have lost about 12, 13, 14,000 crores. They are still losing. And now they want to expand. They want to put another 10, 20,000 crores to expand the losses. And we still have a quotation of 7, 10, 12 rupees because it is called Tata Tele. You can't go wrong buying telecom company from Tata's, isn't it? So you have to be very clear who is going to make money. Just the name doesn't matter. So difference between, in fact, you should pay to the manager for just getting you into the good companies, good and great companies, and keeping you out from the bad company. 99% of the problem in the stock market is because of the bad companies in your portfolio. And they enter your portfolio purely because they are cheap. And then they come and stay permanently and destroy your entire happiness. Then we did the study on dividends. So stock is worth only what you can get out of it. See, don't look at you bought it for 6 months, 1 year or 3 years or 4 years. But if you look at the entire journey of the stock, from the birth to the end, actually what you get, you just get the dividend, nothing else. Rest all is buying, selling. And as a minority shareholder, you are, one guy is buying with other and that keeps going on. But eventually, as a unit, you get only the dividend. Even the owner gets only dividend. A cow for her milk, a hen for her eggs, and a stock by heck for her dividends. So dividend is a very core. And this government doesn't understand. I have been going to SEBI, I have been trying to impress upon the government that boss, don't charge 20% dividend distribution tax. You're killing the cow. You are discouraging the management from declaring the dividends. If you discourage the management to declare the dividends, the value of the company is going to go down. Because by not declaring the dividend, he is going to put in some liquid funds or going to buy something in Quora, something in Zen. Somewhere they'll do some crazy allocations. If that same money comes to you, you will go and buy some wonderful company. You'll have holidays. And actually, the valuation of the company will be double or triple. Like Infosys, if they are paying out 40% and sitting on to 30,000 crores, if they pay out 80% without impacting the growth of the company, do you think value of the company will be same? It will be more than double. And if Infosys valuation is more than double, the valuation of TCS, Wipro, everything will also go double. Because if Infosys is available at 15p or 20p, you cannot sell Wipro at 30p. No way. There is an anchoring effect. And then if all these big companies are available at 15, 17p multiple, the whole market settles at lower level. So you need the dividend to be very, very powerful. And it is very tough to make these guys understand what it means. But if you go in any annual general meeting, you get, those small shareholders, they are so smart. They ask for only dividends and bonus, nothing else. They don't ask for anything. So dividend is important. If you read this particular paper, you'll realize we have given mathematics of how dividends decide the valuation of the companies. Then we did the study on moat investing, actually more to do with the unique companies. How exactly the companies become unique and the valuations, they go much higher, significantly higher for the unique companies because the moats are there and those companies become inevitable. Then 2 years back, we, in the same moats and abnormal profits, what are the sources of abnormal profits? Because what you're looking for, if the amount of money you are going to make in the market is dependent on how much money the company is going to make, then we have to figure out what are the factors which lead to abnormal profit for the companies. Some guys make a lot of money, some guys don't make money at all. Why is it so? Everybody is working hard. All the textile companies, they are working very hard, and yet they incur losses. And then you look at the tech companies, they have wonderful campuses, and they barely work for 8-9 hours, and they make thousands of crores. How is it possible? So how do you identify these kind of companies? Because uncommon profits means abnormal profits in companies is equal to abnormal wealth creation in the stock market. So what are the factors? How do you pick up? So this particular process is understood in this particular study. If you want to pick up, because what happens is every company takes 8-10 years before they understand the game, and they establish their products, they have enough customers, and they start growing in the marketplace. It takes 7, 8 years, 10 years, most of the time. So when they come out from there and they start making money, at that time nobody knows the story. Then the last one we did was 100x, the multi-baggers. You know how many companies and what it took for them to create wealth of more than 100 times in last 20 years. So Infosys did about 5,000 times. Lupin did about 2,000 times in the last 20 years. Asian Paints maybe 100, 106, 110 times. So all the companies, so you know what it takes to make big wealth. And here this guy is saying you need only 3 things. To make big money in the market, you need 3 things. Vision to see them. Because in stock market, what are you doing? You're buying the future. You're not buying the past. It's all about future. You pay 20 lakh crore, 5 lakh crores market cap for a TCS, which makes 20,000 crores. So obviously you're not buying the past or present. You're buying the future. You expect this company to make more than 5 lakh crores in next 5, 7, 10 years. Am I correct? So, you know, you need that vision to say at current price what I am buying, this company is going to make multiple times of this. So in 2003, I was using this particular ratio, and Bharti Telecom was just about broken even, January 2003. And I calculated that in next 5 years, this company is going to make about 27, 28,000 crores profit. And the stock was held for 5,000 crores. The company made 32,000 crores profit. So, you know, you are buying the future. Very rarely you get this opportunity that you can buy what a company is going to make in next 5 years. Say it is going to make 1,000 crores, you can't buy it for 200, 300 crores. But this is the market where you get this. And these ideas, they come once in 6 months, 1 year, 2 years, and when you get them, you must pile on. So, vision to see them, courage to buy them. Should have courage to buy when you see this. Because it's all in the head. It is not written anywhere that this company is going to make this much money. And no analyst will write, mind you. All these highly paid analysts, they are not going to write this. Forget it. You have to do it yourself. So you are very lonely in the market at that point of time. In fact, you call up your friend whom you consider as knowledgeate, and he will say you are wasting your time. So literally, your analyst, your friends, nobody will support you. And when nobody supports you, then you should be very sure that you are on the right track. I mean, I've gone in 35 years so many times like this. You know, once when I was buying Indian Hotel at 110 rupees, I mean 10 rupees share I'm talking about, which went to become 1,000 rupees, 1,200 rupees, whatever. So he said, Ramdev, you must be out of your head to even think about this company. I said, because it requires so much of capital, this, that. I said, very good. I had by that time, actually before asking this, I had already bought more than 1 lakh share. Then I said, Moti, please sell this, because our friend is not agreeing with this. So there is something wrong, we are making some money, let's get out. I put the order at 10:20, by 10:23, the whole thing was taken away. And we came to know that it was bought by Franklin Templeton. And they made all the money. So, you know, whenever you are early in the game, nobody will support you. You have to be convinced about your own thought process. And all these theories, they help you in holding out to the big one. Vision to see them, courage to buy them, and patience to hold them. And the third trait is the most difficult. And the book says that it is rare amongst the men. Sometimes it is found among the women. But there is no women fund manager. You meet only the guys out here. So, you know, patience is very difficult. If you want to do 5,000 times in Infosys, you had to be sitting through 20 years with Infosys. Then only you can make 5,000 times. And there are guys who are there with the 5,000. I think driver of Narayan Murthy, he is still holding out. So he is the one guy who is the smartest. So, it is not the amount of money you put in the market. It is the amount of time you have spent on the stock. Because power of compounding can work only over a period of time. So, as these stories were on in last 20 years, somewhere when we did, I think this study, I think it was just 2 years before that I wrote that now it looks that we have some kind of a process, what works. Because for 20 years we are searching that what is, because if there are a million guys in the market, there are a million ways of making money. And we said this is our way of making money. So we wrote QGLP as our process. And then we started examining ourselves critically whether we are on the right track. And in last 2-3 years, we have realized that it is not the QGLP that is important, it is how much intensity you bring in practicing QGLP. So QGLP will remain QGLP, but what will go behind understanding quality of business, quality of management, growth, longevity of growth and quality, and what price you pay finally. So this mix of 4 things, there is no 6th parameter in investing. Good business, good management, growth, longevity of the franchise, and all this at what price you are buying. So you have to interplay of all these 5 variables. You have to arrive at and put in the portfolio. So this was the 20, 30 years of committing a lot of mistakes on the way, lots of mistakes, and then learning that this is the right way.
Don't forget to like and subscribe. Don't forget